Hello again, everyone. Welcome back to the rationalinvestor.com. This is our FOMC meeting. I don't know, commentary, I guess we'll call it. We'll just sit and banter about what Jerry has to say here today. We did a nice little free broadcast there about an hour or so ago. So if you kind of want some context of what we were thinking heading into this event, maybe go check that out. Um, I don't know whether I see anything really definitive other than it does look like crypto is catching a bit of a bid here. The news headline, Fed leaves rates unchanged. I think although I didn't really find a usable tweet there, it's just a whole bunch of rhetoric from crypto people. I guess, yeah, there you go. That's handy. I was hoping maybe it would just be a nice simple headline from the Fed itself, but I guess maybe I have to follow like different Twitter feeds. I don't know. Anyway, I just clicked on Alan's FOMC, central banks trending, and of course, this is what comes up. Really, all I want is it's just a headline of what happened. If I understand correctly, and of course, we could pull up some of these funny memes, they're hilarious. Um, but if I understand what happened, um, actually interesting. Oh, yeah, well, I guess that makes sense. Um, Going to leave rates unchanged, but they did tinker with their quantitative tightening program. I don't know whether that is a material effect. If anything, I think the damage is already done in the market. And now we could probably start hearing them talking about either, well, I mean, I don't think they're going to lower rates, but I think their propensity to raise interest rates further here is probably abated. Yeah, I just can't find anything really to tweet out that's just a headline. Of course, there's that. Uh, I would press play on some of these, but they're rather colorful. Look at this guy. That's a few cell phones. Um, I don't know whether they're actually printing money anymore. I don't think they are. They only did that when they had to buy those bonds off the Chinese and prevent the Chinese from just dumping U.S. Treasuries into the open market. Well, I haven't really got anything to work with here. Um, I don't know. Maybe if somebody has like a nice little simple headline tweet, the Fed did this, then I could just retweet that out. Let's see. People in the lounge are saying, there you go, Fred press conference, all that kind of fun stuff. Uh, yeah. Yeah, I'm not even quite sure what to. Maybe if somebody happens to have a tweet to just the news headline itself, then I could retweet that out. Actually, usually what I do is I actually when here, I don't know whether these update in real time though. I think it's pretty delayed. Yeah, oh, there you go. Fed keeps interest rates at 23-year high. Look at this. Fucking just more free money to people. Art Institute's students? What the hell's that? Sure wish I could get some of that free money that they keep handing out. Uh, it's May 1st, and people are Wall Street Journal has this headline. That's kind of dumb. Geez, you don't even know what the hell the month of May is going to give us. How do you know the month of May we're not going to go straight down here, you idiots? Man, I hate when they do stuff like that. Obviously, these guys want you to buy more. And I do find that a bit sad about the Wall Street Journal is they're such a mouthpiece for the 1%. I mean, talk about corrupt institutions. I hate to say it. Usually AP is usually a pretty good source for sort of non-directional news, but I don't know. Let's see if they'll show anything. I don't know what this nonsense is. UCLA, man, what a mess that was, huh? No, so they're not even having anything. I don't have anything about the rates. Business, maybe? Maybe we'll get something there. Hey, there you go. Interest rates will stay at 2-decade high until inflation further cools. I'd have to probably agree with that headline. Now, why don't we just tweet that out just so we have something on the feed? Boosh. Boosh. All right. So at least there's something there. Did actually put a really cool tweet out just a moment ago. Sales pitch. Sorry, you're going to get a bit of a shill here while we wait for Jerry. I have to say, if you've never seen this before, you're relatively new to this space. There actually wasn't really anything too out of the ordinary with how this top and Bitcoin just went down. How ironic, went down. Is this the end of the correction? Yeah, maybe. I don't know. Usually the market's pretty soft through my birthday, and really the old adage is sell in May and walk away. And really, we probably won't see a seasonal bottom until we get to July. Who knows? I mean, I don't think it's in anybody's best interest to sort of, like predict the future. You just got to roll with the punches. It was a pretty big fundamental catalyst, the halvening event. We also had a pretty big celestial window, the solar eclipse cycle. And really, I think all they're doing is they're just cleaning up the market because it just got a little bit out of control there. So probably when our indicators start calming down again, that's probably when we start seeing things, reverse. As I was mentioning earlier, the major inflation problem here is this energy market. And the energy markets appear to be breaking here. So you can see this is both crude oil and there's your unleaded. Beautiful analogy. And when I was a commodities broker, this was a pretty popular seasonal trade for brokers to do. This is unleaded gasoline right here, RB. Buy your unleaded gasoline in the middle of February. You can see a nice little breakout there in the middle of February. Sell it the middle of May. You can see we're already starting to break down. May 1st, sell in May and walk away. Stupid Wall Street Journal. That looks like an M to me. And for whatever it's worth, if you're relatively new to all this, student of the market and all that, that expression sell in May and walk away actually comes from the commodities industry. So Wall Street Journal, they're just trying to play us. Interesting to see the natural gas though turning up here. Ironically enough, natural gas is used a lot in like power plants and stuff and industry. You're going to have an inflation problem if natural gas prices start to bottom and take off here. Usually natural gas does well through recessionary windows. You remember during the sickness, that was supposed to be a recessionary window. Of course, they distracted us all with all the great reset nonsense. Yeah, what can you say? It's just, I'm absolutely stunned at the way this society is being played now, and it's like classic economics just thrown right out the window. But oh well, welcome to communist future. I was joking in the public broadcast this morning that how do you actually define socialism? They say that you define socialism as if government is the biggest employer. And ironically enough, um, the U.S. Department of Defense is the largest employer in the world. That is U.S. government. That is the definition of socialism. So, ironically enough, the United States of America is actually the biggest socialist country in the world and in world history. It's a bit ironic. And I suppose all these nonsense stuff that we're going through with these central banksters and the way that they're manipulating the economy. Um, that this is like borderline communism. We have like Politburos. What's the difference between a Politburo and a Federal Open Market Committee? Committee. Isn't that the kind of the terminology that CCP uses? Anyway, we always say never trust the first hour. Following a Fed announcement. So it'd be really interesting. Just if you take a screenshot of this, this is before Jerry speaks. We're about 20 minutes or so into the post FOMC 1 hour window. You can see plenty of volatility up and down and up and down. It'd be interesting to see, like I said, how in this entire matrix, the only thing that's not moving at all is the crude oil and the unleaded gasoline. So this is what I mean by it almost looks to me like this was predetermined. These markets were planned to break and expected to break. And I also think that Mr. Biden, if he's got any hope in hell of holding on to his job, is going to make damn certain that this oil market goes down in earnest here over the next few months. Seasonally, we went through our very normal, I explained it, buy your unleaded the middle of February, sell it the middle of May, made money, not in the past 10 years, blah, blah, blah. And now that seasonal window has come and gone, I would not be surprised to see that hair sniffing committees make a concerted effort in doing everything they possibly can to get this oil price down here over the next 6 months to make sure that we have more hair sniffing in our near future. It is interesting. Everything seems to be lifting in unison here, except the oil. That is fascinating. And of course, the good old US dollar. So I would imagine that the US dollar could be in a bit of trouble here. Mind you, we didn't really hear from them that they were cutting rates. So I don't think we have to be thinking like that just yet. But when we do our US dollar review, which screen is it? I thought it was this one. Nope. Maybe. Oh, is it this one? Yeah, there we go. Oh, jeez. You can see Bitcoin's catching a bit of a bid here. So way to go, Bitcoin. In fact, actually, I think in the free broadcast, I kind of said I wouldn't fault anybody who did short that Bitcoin, that latest bot setup. Oh, yeah, there we go. If you started tightening up stops here, I wouldn't fault you. I mean, it's fallen an awful long way. This funny little free position that we have on the books here from the original shorting off the top. It's just working away here, and that's pretty big numbers. That free position is just working away. So this was a short setup in Bitcoin here that was working over the past little bit. Interesting how we we still haven't hit 877s. There's really no bottom here. All this really looks to me like is the whole risk market is lifting following the Fed event. And I would imagine that the Bitcoin community is kind of reeling right now with Roger Ver being arrested on tax evasion. That's a great one. And what was the other headline? Right, there was another big one. Oh yeah, CZ is going to prison. I mean, it's only for 4 months, but nonetheless, damn. And I suppose CZ just better be thankful he's not in a Spanish jail, a la Mr. McAfee. Mr. Ver is in a Spanish jail. Oh boy, I'd be careful, Mr. Ver. I'm not quite sure how you can avoid not getting unalived. Oh God, this world is terrible. Oh well. So, what I wanted to do before Jerry starts speaking of stuff, maybe just take a look at a bigger picture. This is like a half-hour charts, along with a 4-hour US dollar index chart. Is this some massive top in the US dollar index? It's interesting. This might be these are always, and keep in mind, right? We're ahead of Jerry speaking. I mean, you have no idea what the hell this is going to look like by the time he's done. This almost looks like one of our Olga and then Adam tops. Or you could say, because usually it goes Adam and Eve, but sometimes it does go Eve, Adam. And maybe this is even like Eve like that, Adam. All right. So it'll be interesting to see how this plays out. And this US dollar has come an awful long way. So could we go through a period like through the summer? The stock market has a bit of a nice counter trend rally, and this thing just comes back down to earth quite a bit. It wouldn't surprise me. We're coming up into some pretty important objectives. I don't know whether they've been hit yet or not. Anyway, so this is what I will be watching fairly closely over the next little bit for a major pivot. So let's go listen to Jerry and see what he has to say. I guess, Chris, do you have the link? I guess over on YouTube, you probably have that video with the video overlay, or should I put the video overlay on there?
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to
I'm going to be
promote
playing
maximum
this on
employment
my
and
end
stable
here.
prices for the American people.
I don't know whether
the economy has made considerable progress toward our dual
this will
mandate
come
objectives.
through.
Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Bonds are the key here.
The inflation
Liking what
data
they're
received
hearing.
so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized.
Ooh, bonds are taking off here.
I also look at we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess. Is it?
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways, as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
I think he just dodged that question.
Thanks for taking our questions, Chair Powell. I wonder, obviously,
Mr. Chair
Michelle
Powell.
Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. if we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent
He
has
wants
the
to have his
easing in
baby.
financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
What a load of horse crap.
Rachel.
Hi, Chair Powell, Rachel Siegel. from
Inflation
Washington
is
Post.
caused
Thanks for
by
taking
the
our
ramping
questions.
up of money
You
supply.
talked about needing
Simple as
time to
that.
gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. You know, what we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. What
It was interesting how the
So I
text
thought it was
there was
appropriate to reserve judgment
on the screen
until we had
before
the
he
full
even said
quarter's data,
anything.
until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when services. So,
If I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation?
Yes, it is.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to
Whatever it's worth, I like Steve. He's a
provide
smart guy.
accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Boris from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same?
Look at
That's
crypto
the first
going
question.
for it.
Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the
Does
economic
this guy work
cycle
for
to get it down
Rothschilds?
over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
Hi, Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation?
Interesting how we
that would
won't
trigger
answer
a
that
rate
question.
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election?
Yes.
And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is, when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook. and
Does
the
he
balance of
actually
risks.
believe that?
And then is there a significant difference between, whether you start in, say, September versus December? And economic
There's a
difference?
significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for every, this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand.
And other things.
So many factors did that.
Bursting
So
of the
I
Chinese
think
bubble.
now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen. And you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think
I've said it all along, U.S.
may go
looking
before
for
that.
crash.
In terms
That's
of the
not the place where the
implications,
crash will come.
I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when
Remarkable how closely correlated
on that front,
ETH
either
and
a
Bitcoin
reproposal
are with
or
the
a move
bond?
to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake?
Nice.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
That's all she wrote. Well, we're going to go out and panic buy here. Interesting how the US dollar finished that event on quite an uptick. Everything just sort of went, okay, that's it. Back to what we were doing before. I'm not quite sure how to interpret this. If anything, a really good lesson, though. You should never really trust what you see through this Fed event window here. Things can get all over the place. It's interesting to see the euro. We did have some nice bottoms come in here through the event, though, no doubt about it, and some toppy action in the US dollar. Interesting enough, I'd almost even argue that not nearly as volatile as I was expecting. One thing I was surprised to see, but didn't see happen, was there is a bit of a price gap here on this US dollar index. I don't know whether you can see that or not. So a little bit of a surprise that we didn't come down and fill that gap in. I was expecting that. So the fact that we've bounced smartly right off of this, this is a 4-hour chart. We go and fire an inside bar buy signal, that'll actually probably set up for a move higher here. That was a bit surprising. Really pretty fractal top here to sort of start off the event. And then I guess the thing that jumped out at me was, of course, good old reload zones. This stuff never seems to change. We dipped down into that reload zone against these candle body lows. And then all of a sudden the market just started to lift out of nowhere. Is that more just sort of position squaring coming into the end of the trade? It is 12:22 here right now. So, we've got about 40 minutes left in the regular retail session. If we look at stock indexes themselves, you can see coming into the end of that event, nasty little M's started to perk up all over the place there. So I do believe we've hit some sort of short-term resistance level. And as I had pointed out, the currency's coming off smartly here. Interesting to see the energy markets lifted, but they are really on their heels today. I mean, they got absolutely destroyed earlier in the session. So usually in this case, that actually opens the window for gold and silver and stuff, the metals to actually rally smartly. So yeah, I guess it's interesting to see how the gold and the silver and even the copper, professor of economics, probably actually the best proxy we could have on what is the sort of future for us is does that look like that's topping out? Or does that look like it's just business as usual? We had talked about earlier, I was kind of bitching how the Wall Street Journal saying, sell in May and walk away, not this year. And I had said earlier that actually this saying comes from the commodities industry. It comes specifically from the copper industry. But I don't think the Fed here is putting a top in this market. It's probably going to be just more of just pure good old fashioned market forces. I suppose if you're looking for tops, we should probably be thinking things like bonds. So 2.618. Actually, God, it's funny how I always see David's midpoint of these bonds traded too. Drives you crazy. He absolutely loves that midpoint number. Suppose off the original double bottom about it, what is that? That's like 2 years ago. We are interesting how we have like a confluence of 2.618s in here. So I don't know whether that's driving the bus per se. I suppose if this thing really gets ahead of steam, next stop is a break of these old highs, but I wouldn't be surprised if there has to be a bit of a cooling down period. Probably also too, if we just look at really simple trend line growth, again, could we get some sort of seasonal dip into this window here? Maybe even just a simple Wyckoff check. Yeah, that would be logical. I do find it interesting how, in a typical US presidential election year, usually there's quite a bit of back and forth in the market. But this year, it's just literally been one directional. So that's been a bit of a surprise. So short term, if anything, it just looks to me like the market's almost kind of like a relief rally. I got the impression that it was like it was a sell the rumor, buy the news event. And if that's the case, then we should see, where's a good place to see this? About over here, maybe? So something like sell the rumor. Is that whole event? Buy the news. It's interesting how we had that very quick short-term top come in on those right into the end of the meeting. And look how that was right into this fast moving average here. So I don't know, I had actually commented the other day in our free broadcast that I was a little surprised to see such a huge price gap left there on this S&P 500 futures contract. That's a big asset to have such a huge gap like that. So you can make the argument that yesterday all they did was they just brought the market back down, filled in the gap. It's interesting how it looks like there's actually a gap that's still open here, just a little bit below today's lows. So I'm not totally convinced that we're actually bottomed here yet. I still think there's quite a bit of work to do here. And of course, the time of year. So interesting how, like, if we look at maybe like, I don't know, like maybe a 30-minute chart, maybe it'll show. So, you could make the argument that there's your original top in the stock market. Market was selling off. You can kind of see that it set itself up for a rally here. But did all they do is just counter trend rally the market right back into resistance? So good old reload zones. And there's, of course, Brian's favorite fib just sitting up there. So really, I think the jury's still out. And actually, this is an interesting level for this to happen too, right? Because we've kind of talked about this recently on the free broadcast and in our after party videos and stuff. And it kind of looks to me like we're playing a little bit of sort of reload zone. Actually, let's rephrase that. Colin's pump chaser zone. I'm gonna make this Colin guy famous. But 38.2 to 50% of the sort of year to date range, that rally basically from the beginning of the year here. And then the resistance was basically into the dump chaser zone off of that dump. And we're just kind of playing ping pong here. And I suppose, if you are a fan of trend continuation, I mean, you heard Jerry there speaking, the actual economic data, it's not really bad. It's just sort of like, if it wasn't for the fact that this damn inflation stuff is still so sticky, I think that this economy, actually, they'd be like, everything's awesome. It's just they can't seem to get that inflation number down. But I've talked to you guys about this before. I don't think the inflation number has anything to do with any of the crap that you see happening in our society. It has everything to do with the money printing. And I mean, the guy in the White House is $1 trillion deficits. Like when did that become like acceptable? And it's perfectly fine. So you want to get in front of inflation, you got to put that shit to bed. And actually, I'm a little disappointed that Jerry isn't making reference to that. And I think the reason why he's not making reference to it is because Democrats, they're socialist by nature. This is their mantra. So Jimmy Carter was the president of the United States in the late 70s when we went through that insane inflation nightmare. Socialist president. I thought it was interesting how Jerry made that comment about how they're not political. I call bullshit on that. I call bullshit, bull fucking shit. That is just a load of horse shit. So anyway, that's just Brian's opinion. Brian doesn't really mean a hell of a lot. So there's your outcome of today's meeting. We could probably look at something like half-hour charts to try and get some sort of direction. One thing I did notice that was kind of interesting through all that was to see how Bitcoin and Ethereum actually did fairly well through that whole event. Didn't seem to be any concerns there. Let's see. I think that's what this chart was. Hey, there we go. So looking at a little bit higher time frame. So through the meeting we were just looking at those 3-minute charts, and usually they're actually a lot more volatile than what today's session was. I got the impression, like I said, today it just felt like we had been under massive amount of pressure, massive amount of stress. It was just sort of sell. And if anything, this almost felt like a relief rally. Okay, finally he's going to speak and we'll get this guy out of the way. And the whole market kind of breathed a sigh of relief. And it was almost like the selling pressure abated. As I had said earlier, probably the most important market out of all of these things to watch is our bond market and what is the direction of interest rates. Here is the 2-year note. We used to follow the euro dollar market, but of course the 1% killed that because it was just too helpful for us to avoid their nonsense. So we have on 2 years, probably the best proxy that we have now, 2-year government bond for sort of demand from the marketplace, which should dictate Fed policy going forward. Well, you can see there's a pretty nice looking W down in here. Big launch higher on the event. No, I beg your pardon. I guess interesting. That was yesterday. Fascinating. Actually, not even yesterday. That was a few days ago. Wow. That's like leaving me scratching my head a little bit there. I guess this is the bottom coming out of today's meeting. A little perk up there. On balance, looks like the bond market was relatively happy here. Again, Fed didn't raise rates. I did find it interesting that he would not even talk about the potential of raising interest rates. Again, is that not slightly political? If anything, I almost found that a little irresponsible that he wouldn't even when asked, well, did you talk about raising interest rates? He would not even acknowledge that question. He kept dodging it over and over. So that was a little suspicious. I'll tell you that much by crackers. What I did here was that, well, we think interest rates are sufficient to restrain the inflationary pressures, and we're just going to sit here and wait until we actually see those inflationary pressures abate. I get the impression that the interest rates themselves are high enough to quash this inflationary problem. What I'm curious about is how the international market acts with these high interest rates. We've been hearing lots of talk out of Japan that they're devaluing their currency massively. And I think this is a response. This is the only way that they can respond. Obviously, they can't lower interest rates. They're already at basically zero. So the only thing that they can do in response to these high interest rates is I think the US dollar itself remains very, very strong. And they will try and devalue their currency to export their way out of their local problems. And, the big talk lately is, oh, Japan's raising its interest rate from 0 to 0.1%. Woo-wee, it's a new bull market. Wait a minute. I don't know about that. And if anything, I think that this is what you're going to see, is you're going to see, and Mr. Hendry, if you like following Hugh Hendry, I think he's even placing bets that he thinks that the Chinese are going to have to come out at some point here and massively devalue their currency to try and play catch up with this yen, because this yen is just absolutely collapsing here. And I don't see any signs of a bottom here anywhere in sight. So how can the Chinese not devalue their currency? They have to, in my opinion. And, if you don't listen to me, you listen to guys like Hugh Hendry, he's a pretty smart guy. I think he's actually placing bets, expecting the international markets to crumble. So, it's I don't think it's I even barked while he was speaking. I don't think this has really much to do with the US economy. US economy, I think, is actually very strong. It's going through its natural growth cycle now. We have transitioned from the fear cycle to the greed cycle, which technically actually happened through that whole currency, well, not currency, but sickness, crisis, nonsense bullshit that was all rammed down our throats. And the Americans are driving the bus right now. They are in complete control. And of course, I think that's entirely what the 1% and Rothschilds and all that crap wants. So it'd be interesting to see how much of a role international wise crypto actually plays in all of this. Of course, Mr. Fink is US based. I don't see these deficits going away anytime soon. So I don't think the fundamental reason to actually be long something like a Bitcoin, fixed supply, relatively honorable governance system. You don't have the rugged on Bitcoin. When it comes to the little altcoins, caveat emptor, be careful with what you're getting involved with there. But with regard to something like Bitcoin, and to a certain degree, I would also say Ethereum, I think it's pretty grown up now. I think that the case for further and higher prices for Bitcoin down the road, I'm perfectly comfortable with that. And if anything, I think pullbacks are buying opportunities. It got a little stupid there a month or so ago. This time it's different, all that kind of nonsense talk. And I think they've just had to clean this market up. It was just way too far, way too fast. And I might even argue things like what we should do, calling pump chasers on. You saw the S&P was doing that. They should probably come back and kiss 38.2. This is 38.2 off of the entire range there. Come back and kiss this, and just all this is doing is just cleaning up the excesses of the pre-halvening pump. Then we can just go back to range, range, range. And what I would strongly suggest you do is find the good quality fundamental names. And shameless plug for TRI. We do have a list of names that we have invested some substantial amounts of money in. These are Sjord's hot picks within the sector. And frankly speaking, I have 100% confidence in Sjord and his crypto picking abilities. I would be very careful with the touts. This coin will go 100x this coming cycle. I've just made some notes here of recent touts that these, and when the public comes out and touts that these things are going to go straight up, that's usually a note that they're going to actually go straight down. So it doesn't really surprise me to see a bunch of price weakness. And for whatever it's worth, I have a smaller little old lady portfolio that we're working. And I've just been basically telling our audience, look, I've had my own issues dealing with ledgers and DeFi and my own order execution. So that really doesn't have anything to do with the investability of these names. Of course, your own jurisdiction, you better be careful with what you're buying based on what Big Brother wants you to do and not do. But I would make the argument that as soon as these things start Wing out, I'm going to be coming right back on the buy side and pounding the table to get right back in on the long side of the market. It's just, we need to clean this thing up. And I suppose finishing off this conversation, we'll have a fun session with our buddies over at Coinigy tonight, talk a little bit about crypto in the altcoin markets, and maybe take some of your requests and look at them. I think this is the total market cap proxy here. I think you can make the argument there were pretty well defined tops, technical tops, lots of reasons to be thinking down. I think those setups are playing out business as usual. And again, really not looking, and this is what really bugs me about sort of, and you can see it in like newspaper, or not really newspaper, but the headlines and stuff, especially out of like Wall Street Journal, because they've got a major hate on for crypto and Bitcoin and stuff. They're labeling this a crash when clearly, you look at the price charts, that's not a crash at all. This is just a very normal, very healthy, very typical market correction. There's no crash here whatsoever. So slow and steady wins the race. Don't take no wooden nickels. If you want to take a look at some of these alts in earnest, maybe join our call here tonight with the good people at Coinigy, or pop on the website. And of course, we have little video clips of Sjord making the case for why he really likes his FA names. And as you can see, there aren't really any W's working here. I suppose Route is trying to W, but I don't see any W's to get all excited. I think we are sort of in midstream correction. This is May after all. And really, my message to the world and sort of to the public is I have these fun little demo shorts off of the top. I'm not even really in a big hurry to do anything here whatsoever. I still think Bitcoin needs to come back down into sort of, 38.2s of recent ranges, 61.8s, reload zones, 50% of entire ranges. That's what happened in 16. So I'm not really in a hurry to change my tone here. It's just really a question. If anything, what you should be doing now, in my humble opinion, is you should be getting your plan together. You should be figuring out what type of risk taker you are. Then that defines, what kind of money you're going to put in relative to the size of your stake in any one idea. And you should be building your shopping list. Maybe you're interested in some of these names. I would do yourself a favor and take a real good look at Sjord's names, because Sjord's one of the smartest guys I've ever met in the crypto space. And if he's interested in something, damn well I am. But just, you got to be getting that, get your plan together so that when you do start seeing all the W's start coming in, like I said, I don't see any W's here yet. When you do see the W's come in, you're ready to go and you're ready to pull the trigger, and you know exactly how much of your capital you're willing to allocate, and you do this with a completely clear head, because that's the way professionals act in the market. Okay, why don't we leave the rant at that? Hope you enjoyed that. We'll see everybody, of course. I guess tomorrow is Thursday, isn't it? So I'll be off. Julian will be with you. And I'll be getting together with the Coinigy people tonight, Joe. So we'll have a fun conversation if you're up for it, if you're in North America or Asia, I suppose, even early morning for them. Unfortunately for the Europeans, it happens at kind of an awkward time. But check out the tweets that we put out, and by all means, if you need the links to the Coinigy shows, just PM somebody on the site. We'd be more than happy to get them to you, or PM me on TradingView. But I should probably have that link in my Twitter feed for you. Okay, why don't we leave it at that? Have yourselves a great rest of your day, Chris. If you could take us on out here, I'd appreciate it. All the best. And the only thing left for Brian to say to you good people is bye for now.